Next, you have property subject to amortization. Similar idea. Amortization typically over 15 years. Not quite as valuable typically as depreciable property, but just by virtue of the volume that most companies have. Typically, companies will have an asset spread that includes more depreciable property than it does amortizable property. And amortization is usually straight line, whereas depreciable property is often none. You have bonus depreciation, more significant depreciation going on, more significant expenses going on. Then you have the property subject to depletion. Depletion is like usually with a mine or something like that, or a coal mine or something that was purchased, where you get to deplete that property over time based off what you pull out of it. Timber is kind of similar to that. And then all of the remaining properties. If we've been through the first three and there's still money left over, there's still negative basis that has not been assigned, we're just going to assign it to other properties that are remaining. So these work in an order of priority. You're going to get rid of all of your depreciable property first. Then you're going to eliminate the basis in all of your amortizable property, and then all of your depletable property, and then other remaining properties. Other properties not as important in terms of tax avoidance because, for like land, for instance, there's no depreciation on land. So lowering your basis in land isn't going to affect current expense items. It's just going to change the gain that you recognize on the sale of that land. And you may not ever sell that land, or at least not within the next couple of decades. So it may not be beneficial to you to lower that basis in any way or any meaningful way. Well, to correct that statement, it may not affect you in a negative, meaningful way by lowering that basis because, again, it's just a built-in gain that you may never actually recognize. So next, let's think about debt capitalization a little bit. So you can imagine a scenario where debt is similar to contributions of capital or stock in a company. So when you typically think of stock, there are a number of attributes to stock that you'll think of. And when you think of a bond or debt, there are a number of attributes to that. And they're typically fairly different. So think of stock, you'll think of owning the company, owning the upside of the company, having a voting right within the corporation. A couple of other things include dividends and not interest. You don't receive interest on your stock. You just receive dividends on whatever profits the corporation musters for the year. So that's kind of what you expect from stock. Then you have something called preferred stock. Well, preferred stock has a preference in terms of when the dividends are paid. So it's a little different in the sense that the requirement to pay out, there isn't a requirement still, but since whatever dividends are paid, preference goes to the preferred dividends. If this is a company that declares dividends every single year, like clockwork, the preferred stock is going to be very similar to a debt instrument in the sense that they're getting these preferred payouts on a very consistent basis based off the business practice of the corporation. And it just starts to look a little bit more like debt when you have preferred stock. You can also add attributes to it. You can have the preferred stock have a specific payout based off the initial value of the preferred stock at issuance from the company. And so if the company contractually agrees, for instance, to make these payments every single year, pretty much this is starting to look like not a dividend to the shareholder, but it's starting to look a lot more like interest payments. And so you can see that there's some crossover there. Just because it says this is debt at the top of the paper or at the top of the loan, it doesn't necessarily mean it's debt. You got to look at the actual nature and character of the instrument. Although generally it will be. But the point here is that certain non-qualified preferred stock is not deemed to be stock for purposes of 351. So in terms of controlling the company after, and in terms of meeting the exchange for stock rules, this non-qualified preferred stock is not deemed to be stock. So you can blow a 351 by issuing non-qualified preferred. Interestingly, sometimes you might not want to have a 351 transfer. Maybe you're transferring a bunch of lost property, or for whatever reason you just don't want a 351 to attach to the transaction. Well, a great way to pull it out of Section 351 is to issue non-qualified preferred stock. And one element of non-qualified preferred stock is that it's often easily converted at the option holder's discretion into bonds. And so it's essentially convertible stock into bonds, and so this looks a lot more like a debt instrument and not like an asset or a security in that sense. So certain types of debt are also, just like certain types of stock are not really stock but are in fact debt. Certain types of debt are not in fact debt for purposes of deducting the debt expense. And once again, you kind of have this sliding scale between equity and debt. And if you're going to be taking the deductions, it needs to be clear that what your corporation is looking at is debt. So let's take a look at the general rules for investor losses. This is a little bit of a review from your income, individual income tax class. Since we're dealing with shareholders, though, you can't really get the full picture on corporations unless you think about the shareholders a little bit. So sorry for the review, but it's worthwhile here. Generally speaking, if stocks or bonds are capital assets in their owner's hands, then losses from those bonds are governed by Section 165G1, and investor losses are generally disallowed. If you lose money on stocks, long-term capital losses, for instance, you can only take that against ordinary income to a very minor extent. I believe it's about $4,000 a year. I could be wrong on the specific amount, but the point is there's a limitation on the capital losses that you can take. So if you own shares of stock, the general rule is that under 165G1, you'll get no deduction allowed for the decline in value, and the only way you're going to get to recognize a deduction is when you realize a sale of that stock. And that deduction is going to be limited to the $4,000 limitation every year. So if you have like a $50,000 loss, you can imagine a scenario where someone would be anxious to take those losses, accelerate those losses a little bit. Well, that's where Section 1244 stock comes into play. Section 1244 is a provision that essentially seeks to encourage moneyed individuals to invest and take risks. And one of the things that was, at least based off the understanding of the legislators who passed this section, one of the things that was concerning was that people were not investing, because if they invested in a startup, for instance, and then the startup went bad and they lost their full investment, they're stuck with either a bad debt expense or even, in some ways worse, a long-term capital loss if they sell their stock. And so the idea between 1244 is to find an exception to that, which allows small business corporations that meet certain criteria, and it's really important to meet that criteria, but small business corporations that meet certain criteria are allowed for the first $1 million of capitalized value of the corporation's stock to receive ordinary loss treatment. So that means the first $1 million that this company loses is going to be used as ordinary loss for the shareholders if the stock becomes worthless. And so there the mechanics of the loss deduction are that the amount of the ordinary loss deductible in any 1 year for the disposition of 1244 stock is limited to $50,000 or $100,000 for taxpayers filing a joint return with a spouse. So this $1 million, if you have it split up among 10 shareholders, all of which are married, then you're in luck. You have worthless stock. All 10 of them can take a $100,000 deduction that year. Alternatively, if your loss exceeds this amount, then the remainder is considered a capital loss. So you just utilize the old capital loss rules there. So again, $1 million corporation-wide is the limitation. And then shareholder specifically, the loss is $50,000 for single shareholders or $100,000 for other taxpayers. So for kind of mid-level investors, individuals who are investing in companies, maybe putting $100,000, $200,000 into companies, this is a really good rule to have on your side. But the corporation, there are a few mechanical issues and limitations, and you have to meet all the requirements of 1244.